Hey CMA buddies, let's today start with 9.4 module 9, and we'll be talking about one of the most important chapters from exam perspective, and that is portfolio analysis and BCG matrix, right? So BCG matrix is something which is very expected in the question paper, so you should be well prepared with it. Let's start and understand what exactly is portfolio analysis. Portfolio generally means a set of things, a bunch of things, right? For example, if I talk about a stock portfolio, that means a stock portfolio will consist of a number of equity shares, right? So that is my stock portfolio. So that means Bajaj Finance, ICICI Bank, I would say HDFC Bank. These are all the shares I'm having. So this entire thing would comprise of a portfolio, right? So portfolio is basically nothing but a bunch of things, right? So let's understand what exactly is portfolio analysis. Portfolio analysis is basically an analytical tool. So it helps you to analyze, which views a corporation as a basket of portfolio of products or business units to be managed. So when we talk about portfolio analysis from a strategic management point of view, we talk about a corporation or an organization that has a portfolio of products. That means they have a lot of products. For example, if I talk about HUL, that is Hindustan Unilever Limited, you will have soaps, you will have shampoos, you will have staples. So these all comprise of basically a portfolio. That's what it talks about. Or business units, right? So for example, Reliance itself is a big entity, and within Reliance you will have small entities, right? They will have petroleum, they would have Geo Finance, so they would have other units. So Reliance on a whole is a conglomerate, and small units under it becomes a part of its portfolio, right? So what exactly is a portfolio analysis? It's basically an analytical tool which views a corporation as a basket of portfolio of products or business units to be managed for what? For best possible returns. This is very important. You basically manage, you analyze for what, to ensure that you get the best possible returns out of that. Now, top management views its product lines and business units as series of investments from which it expects a profitable return. So the top management that is there in the organization, that is the chairman, CEO, etc. How do they view their product lines? Product lines can be either product or the services, and all their business units. So basically, when we talk about portfolio analysis, it's a composition of two things. One is the portfolio of the products and the business units. So how does a top management look into it? Top management basically considers its product lines and business units as a series of investment for what? Which expects it to give a profitable return. So eventually the purpose of portfolio analysis is to ensure that all these portfolio products as well as the business units are able to give you the best possible returns, right? As there are large number of strategic alliances in today's corporations, portfolio analysis is also being used to evaluate the contribution of alliances to corporate and business unit objectives. So the basic idea, now you know there are a lot of corporations which are working together, right? That is what is called as strategic alliances, or various business units may be coming together and working together for maximization of the profit. Again, that can be called as a strategic alliance. So portfolio analysis is basically used for what? For evaluating the contribution of those alliances towards what? To the corporate and for the attainment of the business objectives, business unit objectives, fine. Now the two most popular techniques are, one is BCG growth, that is the share matrix, that's what we call, and one is G business screen. This is not something we will be focusing on. Our focus will be primarily on BCG growth. Boston Consultancy Group, however you want to pronounce, they have a matrix, and we will be concentrating on this matrix. This will exactly tell you how does a portfolio analysis work, right? So please remember both of them, but the one we will be concentrating on will be the BCG growth matrix. Now, what are basically the objectives of portfolio analysis? What does a portfolio analysis do? It analyzes the current mix of business and take investment decision. So you need to know what is the current mix. Now this mix can be basically a mix of the products that you have, or basically the mix of the business units, and you take investment decisions as per that. So whatever the mix is, and for the growth of the business, if some investment needs to be done, that would be completely based on the portfolio analysis. You develop strategies for adding new business in portfolio, thereby inducing growth. Inducing means you basically provoke, or you basically take steps to increase the growth of the company. So you primarily develop various strategies so that some new businesses can be added into the corporate portfolio. How, for what? For basically inducing growth. Decide the business to be retained and the one to be excluded from the portfolio. So portfolio analysis will be telling you what all business units you should be having or continue to have it, and if the business isn't performing up to the mark, then you basically discard it or you just chuck it out of the system. So that's what are the objectives of the portfolio analysis. So let's quickly revise. One is you analyze the current mix of business and take investment decisions on based on that. Sorry. You basically develop strategies for adding new businesses in the portfolio, thereby inducing growth. And finally, you decide the businesses that are to be retained and the ones that are to be excluded from the portfolio. Fine. What are the various advantages of portfolio analysis? Sorry for the spelling here. The various advantages of portfolio analysis are: first, it says encourages top management to evaluate each of corporation's business individually and to set objectives and allocate resources for each. So you should not look business on a whole. How does portfolio analysis help you is that it will help you to analyze each business unit on its own individually, right? And you basically set the objectives as per that, the objectives which should be dedicated to that particular business individually, and you should allocate your resources for each of them accordingly. Reviving the use of externally oriented data to supplement management's judgment. What do you mean by external oriented data? External oriented data simply means any data that is originating outside the organization. For example, you can say market research data or some kind of social media or any kind of government reports. Fine. So you basically have to revive the use of what? Externally oriented data for what? For supplementing. Supplementing means what? To basically support the management judgment. So management judgment will be based on something called as external oriented data. External oriented data is nothing but it's basically a data that originates outside the organization. The various examples can be research data, market research data, social media or government reports. Fine. It raises the issue of cash flow availability, which can be used in expansion and growth. So you know that every company prepares what? A cash flow statements that tells you how much cash rich they are, right? How much cash they are able to save out of the profits that they make. So higher the cash flow, the better for the organization. So it basically raises the issue of cash flow availability for what, and what is cash flow basically used for? It can be used for the expansion and the growth purpose. Its graphic design facilitates communication. So if the portfolio analysis graphic is well in place, that will help you to communicate in a better way. So that's what are the various advantages of portfolio. Fine. So first of all, it encourages top management for what? For evaluating each of the business unit individually, and you set the objectives and you allocate the resources for each accordingly. You revive the use of what? Externally oriented data to supplement management judgment. You raise the issue of cash flow availability for use in expansion and growth, and finally, its graphic design basically can facilitate communication. Right? Now coming on to the limitations of portfolio. Fine. Portfolio analysis. What are the various limitations? First of all, defining product or market segments is difficult. So you may have various categories, but you need to know in portfolio analysis what is to be kept where or what is to be placed where. So there may be confusion regarding the segmentation of the product on the market. So hence defining product or market segments may be difficult. When we go to the BCG matrix, this point will be more clear. Fine. Then you suggest the use of standard strategies can miss the opportunities or be impractical. That means you're very redundant. That means you're using the same kind of strategy again and again in every given situation. So what that can do is that basically can make you miss the opportunities that are available in the market, or that can be a pretty impractical thing also. So hence that's one of the limitations of portfolio analysis. Then it says it provides an illusion of scientific precision, while in reality positions are based on subjectivity. So it's not very it should not be very hard and fast. That means this is the only thing that you follow, but you are under illusion that this is what we have to do. So the question of flexibility is not there, right? For example, if a company is following a particular procedure, now if there is a change in the environment, then you got to change it accordingly. Otherwise you will lose it on the market share. Simple example can be that of Nokia. Fine. What Nokia company did was, when smartphones were launched, the Nokia was very reluctant to change to the smartphone features. What they did was they continued to use the same keypad kind of model that they had. So eventually what happened is that they basically lost a lot of market share because of that. So that's what it says. It provides an illusion of scientific precision. So Nokia, because they were successful in that keypad system, they continue to do that. But in reality, positions are based on subjectivity. That means whatever is happening in the real life or in the present situation, you got to adapt according to it. If you miss out on that, then you will be losing on the market share. So that's what it talks about. Then it says its prejudiced terms such as cash cow and dog can lead to self-fulfilling forecast, fine, or prophecies, what you say. So basically it's prejudiced term. There are two things or two animals that are considered when we talk about the BCG matrix. One is called as a cash cow and dog. We'll try to understand it in a better way. So basically if you just follow the portfolio analysis system, its prejudiced terms which are cash cow and dog, that basically can lead to self-fulfilling forecast. That means self-fulfilling forecast or prophecy means it's basically a psychological phenomenon wherein your belief causes up predictions to come true. So you think whatever you're doing is right, but you're not trying to change. This is very in tandem with what we studied in the last point. But here it is specifically concentrating on the various components of the BCG. So its prejudiced terms that are cash cow and dog can lead to self-fulfilling forecast. Again, when we come to the BCG matrix, this point will be more clear for you. Not always clear what makes an industry attractive or where a product is in its life cycle. So what portfolio analysis is doing is it's basically limited in its scope. So you will never get to know how the industry is basically attractive or in what phase of product it's in its life cycle. What is a life cycle? Life cycle simply means, if you would have seen this chart, here in axis you have sales, and in this axis you have what is called as time, and you would have seen that there are 4 bars over there. One is the intro bar, then the next stage is the growth bar, then you have something called as maturity, and then you finally have a decline. So you would have seen a chart that in introduction the chart goes like this, then growth, there is a growing phase over there, then maturity it just stables, and decline it just comes down, right? So this is the product life cycle, fine. I hope you would have read it. If you haven't, then you will come across it. This is what is product life cycle. And portfolio analysis, it's never clear as to what basically makes an industry attractive and where a product is in a life cycle. So you will never get to know in which phase the product is basically belonging to as far as the PLC is concerned, fine. Naively following the model of portfolio model may actually reduce corporate profits if they are used inappropriately. Naively means innocently or unknowingly. So if you unknowingly just follow the portfolio model, that basically what it can do is it can take a hit on basically corporate can take a hit on its profits because if they are not used appropriately or basically as per the rules. So these are the various limitations of portfolio analysis. So what are the various limitations? First of all, you defining a product or market segments can be difficult. The suggest the use of standard strategies can miss the opportunities or be impractical. It provides an illusion of scientific precision, while in reality the positions are based on subjectivity. Prejudiced terms such as cash cow and dog can lead to self-fulfilling forecast. Not always clear that what makes an industry attractive or where a product is in its life cycle. And if you naively or innocently follow the model of portfolio model, follow the portfolio model, you may actually reduce your corporate profits if they are used inappropriately, right? Now we come to the most important part of this chapter, that is the BCG matrix. Now this is how the matrix basically looks like. Now this matrix is divided into 2 parts. The left part basically talks about the market growth rate, and the right talks about the relative market share, right? So these 2 things you need to remember, right? For on the left side you have what is called as a market growth rate, and the right one talks about the relative market share. When I talk about the market growth share, it can be basically low or it can be high, fine. So market growth can be basically on a lower stage or a higher stage, and when I talk about relative market share, again it can be low or high, high or low, fine. So first you have high and low on the left side, then you have high and low on the right side. Now you have 4 components in this. When you talk about market growth rate which is high and the relative market share is also high, then I'm talking about something called as stars, fine. So if both of them are on a higher side, then I'm talking about what? I'm talking about stars, right? And if I'm talking about both which are low, right, your market share is also low and your market growth rate is also low, so this is called as dogs, fine. So dogs and stars are basically the 2 extremes. Stars means it's prospering, dogs is it is at a very declining or in a very bad state, right? Now there are 2 stages which are between, which is if you have a high market growth rate and a lower market share, then you talk about something called as a question mark. Fine. Vice versa, if I say there is a high market share and a low growth rate, then I'm talking about something called as cash cow. Fine. So how do I remember this? If both are high, then it is a star. When both are low, then it is called as dog. Fine. When the market growth rate is high and market share is low, then that is called as question mark. And if the market share is high and the market growth rate is low, then it is called as a cash cow. Fine. Okay. Or the other way of you remembering this is stars. On the right of stars, you have called something as question marks, and both the animals fall in the bottom category, bottom of the entire structure that we are talking about. So you know where exactly you have stars and where exactly you have dogs. With dogs you generally have cows, so both animals come under this category. And when I say the upper part of it, with stars you have something called as question mark, or the fill in the blanks can be called as a question mark, right? Okay, let's try to understand this concept. Now, market share and market growth are critical factors for determining attractiveness and balance. So the basic idea of market share is what? This is the market share we are talking about, and the market growth. So this entire matrix is based on only two things. One is market share and the market growth. Fine. So if market share and market growth are critical factors for what? For determining attractiveness and balance. So that's the idea of having this BCG. High market share and high growth rate are attractive, but BCG matrix also warns that high growth demands heavy investment in order to expand capacity or develop brands. Fine. High market share and high growth is something that everyone wants. That's why it is so very attractive. But if you have to have both of it, then you have to make sure that you basically make heavy investments for what? In order to expand your capacity or develop the brands. Right? In order to maintain portfolio balance, there shall be some low growth business making sufficient surplus to fund the investment needs or higher growth businesses. Now, there may be a situation wherein you will have the companies wherein there shall be some low growth business, but it may be making sufficient surplus. Fine. So, for example, you may be having dogs in your business, but they may be creating some kind of surplus for you. So, again, you cannot say it has to be completely discarded. More often than not, you won't be requiring this particular portion in your portfolio, but there may be situations when you basically have to have them. Right? So it's not that you have to completely discard. It depends on the kind of organization or the corporate that you have. Right? Now BCG matrix define four sorts of businesses. So that's what we are going to understand now. The first one is star. What does star tell you? Star says business unit having high market share in a growing market. Fine. That's what we have discussed already. Business unit may be spending heavily to maintain growth, but high market share should yield adequate profits to make itself self-sufficient in terms of investment needs. That means the amount should not be borrowed from the external factors. The star in itself should be capable of yielding adequate profits. Yielding means what? Giving you adequate profits for what? For making itself self-sufficient. That means they should be able to sustain themselves. That means they should not borrow funds from others. For what? For meeting their own investment needs. So that's what is star all about. So star says a business unit having what? High market share in a growing market. That's we have already understand. Business unit may be spending heavily for what? To maintain growth. But high market share should yield what? So growth will be very much intact in star business. But if you have to have a high market share, then you should be able to yield adequate profits and you should be self-sufficient. So two things. One should be you should be able to make adequate profits, and you basically should be self-sufficient for what? For meeting your own investment needs. So that's what a star all about. Then the second one is what? Question mark. Question mark can also be called as a problem child. Why do we call it as a problem child? Let's understand. A business unit in a growing market but not with a high market share. So if you just look at this table, high market growth but lower market share. That's why we call it as a question mark. Why is that so? Converting question mark into stars takes heavy investment. So there may be a lot of market growth in it, but there may not be a big market share because you may not have sufficient funds for what? For converting a question mark into star, because it itself take a lot of heavy investment. That means it is not self-sufficient in a way. That's what it wants to indicate. It is important to make sure that some question marks develop into stars. Fine. as existing stars eventually become cash cows and cash cows may decline to dog. So that's a state that we are talking about. So please do understand that every question mark, the next level that they should be moving to should be that of a star. So question mark should basically be moving into the star phase, right? Because that's what indicates a high market growth and high market share, and that's what everyone aspires to. Eventually these stars will turn out to be cash cows and then it will become dogs. But when it is on a stage of a question mark, you should ensure that it becomes a star. That's what your concentration should be on. That's what it says. It is important to make sure that some question marks develop into stars as existing stars. Eventually that will turn out to be cash cows and cash cows may decline to dogs. Right? So basically a business unit in a growing market but not with a high market share. That is what is question mark, but you eventually should aspire to become a star. Star eventually will become a cash cow and then it will become a dog. Okay, then what exactly is a cash cow? Cash cow is basically a business unit with a high market share in a mature market, right? It will have a high market share, but the growth rate will be very low. That's what it talks about. The best perfect example that can be of a Nestle company, right? Nestle is basically, if you would have seen the financials of the Nestle, you would have realized that it is basically a good cash generating machine. That means it has a solid cash flow. Why? Because it is already a very established business. Fine. So it's very easy to sell Nestle products. But the problem with Nestle is that it is so very big, the growth from here is basically stagnated. Hence, a company like Nestle can be called as a cash cow. That's how you should remember. Fine. I'll repeat that once again. Nestle is something, for example, you have a product like Maggi. Fine. Maggi is so very famous that it generates a lot of money for Nestle. Fine. But there is a saturation to it. It can generate a lot of money, but where is the growth? There is no growth in Maggi hereafter. So hence, it can generate a lot of cash flow. It can give a lot of cash flow to the business on a whole. But now this cash cow cannot become a star because it has come to a saturation point. So that's what it says. Hence, they have a high what? They have a high market share. Right? That's why we say that a company like Nestle have a high market share, but they have a low market growth. There's a limit to it, right? Basically, it's in a very mature stage when we talk about the product life cycle. But hereafter, it can only go to decline. Now, it is not possible for it to reverse and go to a growth stage. Fine. And now I hope you understand what exactly is cash cow. So business unit with a high market share in a mature market. So that's what we refer to in PLC. That is the product life cycle. However, because growth is low, investment needs are less. That's very obvious because you don't have much of a growth. You won't make a lot of investment in it. While the high market share means that the business unit should be profitable. And that's very obvious that if you have a high market share, it's very likely that you will be profitable. Cash cows can be cash providers helping to fund business in question mark, right? So basically what happens is you may generate a lot of cash from the cash cows and that eventually will go, this cash can be basically allocated to question marks so that it can grow further. Fine. Then finally we come to dogs. Dogs is what? Dogs is basically the end stage. Business units with a low market share in a static or a declining market. Right? So in all these things, you have to understand that the product life cycle concept is very, very important. Fine. You would see that everything is basically either on the introduction stage or the growth stage or the maturity stage or the declining stage. Fine. So now we are talking about the declining stage, that is dogs. It says business units with a low market share in a static. Static means stagnant. That means it is not moving anymore. Or declining market and are thus the worst of all combinations. It's a worst of all. If you compare all four, this is the worst of all. They may drain a lot of cash. Why? Because and use a disproportionate amount of company times and resources. Because it has a low market share and a low growth. So what will happen is because you need to keep the business operational, that can basically use a lot of your cash. Fine. There will be a lot of expenses, but it may not generate a lot of revenue for you. And it may use a disproportionate amount of company time and resources. BCG usually recommends divestment or closure of such units. So the last resort of this can be if it has come to a dog category, more often than not, it is suggestible that you basically shut such kind of companies. So that's what is dog all about. Now, I hope you understand all this four. Please look at the video once again. I have tried to make you understand in as simple language as possible. Very, very important from examination point of view. Fine. Now we come to what are various advantages of BCG matrix. Fine. First of all, it provides a good way of visualizing the different needs and potential of all diverse businesses within a corporate portfolio. So you exactly know what product lies under which category. So it basically gives you, or it helps you to visualize different needs and potential. Potential means scope of growth of all diverse businesses within a corporate portfolio, right? In portfolio, whatever you have, you can have a good visualization of that. It basically helps businesses determine best strategy for what? For each product, such as investing, maintaining or divesting. So it helps you basically in three things. One, with respect to product strategy, one is investing, the second one is maintaining, and the third one is basically divesting the product. Divesting means dissolving if it is not profitable enough. Fine. It categorizes products based on market share and growth rate. That we already know. That's what the BCG talks about. How can that help you? Which can help businesses understand their competitive position. So market share and growth rate eventually with the help of BCG matrix can help you to know where exactly you stand in a competitive world. It helps businesses allocate resources to product based on their strategic importance and financial performance. Right? Then it helps businesses develop growth strategies for different products, ensuring high potential product receive the necessary investment. So you analyze which products are better and doing well, and you basically with the help of this BCG matrix can make sure which product needs the maximum allocation of funds, fine, or the resources for that matter. It can help business mitigate. Mitigate means basically to reduce the effect of something. So it can mitigate and manage risk. So it can reduce the risk also, and it can help you to manage the risk also by helping them focus on strategies that are compatible with the industry environment. Fine. So these are the various advantages of BCG matrix. So how do I remember this? First of all, it basically gives you a a good visualization technique for what? To basically know what is the various potential that all the diverse businesses have in a corporate portfolio. Then secondly, it talks about three things. What these three things can be: investing, maintaining or divesting. For what? Basically it will help you to determine the best strategy for each product in terms of investing, maintaining or divesting. Fine. The third one, it talks about high growth and high market share. This will help you to know the competitive position of the company in the industry. Fine. It helps basically help you to allocate resources based on what? On the strategic performance and the financial performance. It basically helps businesses develop growth strategies for different products, ensuring high potential product receive the necessary investment. So it can help you to know the growth strategy. And finally, it basically help you to mitigate and manage the risk. Mitigate and manage the risk. For what? By helping them focus on strategies that are compatible with the industry environment. Fine. Okay. Finally, we come to what is called as three potential problems with BCG matrix, or you basically can say the limitations, right? What are the problems with BCG matrix? First of all, first is definitional vagueness, right? What do you understand by that? It can be hard to decide what high or low growth or market share mean in a particular situation. So basically all these terms are defined. Vagueness means there is no clarity on that. So BCG can make you fall in that trap. It can tell you, or it can be very hard to decide for you what high or low growth is or what market share means in a particular situation. So that's one drawback or the flaw of BCG matrix. Managers usually define themselves as high share by defining their market in a narrow way. See, if I am looking after a particular product, I will define myself as belonging to a high share by defining their market in a narrow way. So you will be very concentrated. Fine. In that case, what it can lead to is you will be missing on certain opportunities. For example, ignoring relevant international markets. So in your market, you may be a big hero, but with respect to international markets, you may not be going. Simple example can be of IT companies right now. You can be seeing that we as Indians are basically good IT providers. We assume that our IT will prosper by leaps and bounds, but the AI technique which is getting popular day by day in the global world, India is not right now assumed to take a lot of positive steps or measures towards it, right? So we are thinking very narrow, right? So in that case, that becomes a case of definitional vagueness. This I'm talking in terms of macro environment, but in company specific also such kind of issues may arise, right? So you have to make sure. It may be hard to decide what high or low growth or market share is, because managers usually define themselves as high share by defining the market in a very narrow way. because they ignore something called as ignore various aspects which are macro in nature, for example international markets. Fine. Then second one, you talk about this capital market assumptions. First, there are 2 points in this. First of all, it says there is a notion, that is there is an assumption that parent company, that is the main company, or the for example parent company means what, Tata Group on a whole, needs a balanced portfolio to finance investment from internal sources. How do you finance investment from internal sources? Basically through your cash cows, right? Example I spoke about, for example, if you need a fund for a particular business, then I talk about Nestle. Or you basically can say, if I talk about a Tata Group, you say for example a Tata Motors. I assume that Tata Motors is basically a cash cow, they generate a lot of revenue. Assumes that the capital cannot be raised from external markets, for example by issuing shares or raising loans. So they assume that all the finance needs can be catered by the cash cow itself. You need not go to the external markets for for raising of funds. I'm just telling you for the example purpose. Please don't try to correlate in the real world. It says that notion that parent company needs a balanced portfolio to finance investment from internal sources assumes that capital cannot be raised from external markets. So they are under an assumption that they cannot raise the money from the outside world by issuing shares or raising loans. They think there is a capital market assumption when we talk about BCG matrix that the entire funding can be done by the cash cow itself. So that's one of the flaw. Then it says balanced portfolio concept may be more relevant in countries where capital markets are underdeveloped, or in private companies that intends to minimize dependence on external shareholders or banks. So balanced portfolio can work wherein the countries basically are very underdeveloped. That means it's difficult to raise money from the external market. That's what the underdeveloped markets have to go through. Or even in case of private companies who are basically bootstrapped. Bootstrap means they want to basically do funding from their own profits. So in a private companies that intends to minimize dependence because they don't want to have a dependence on external shareholders or banks. Hence the capital market assumption is one second flaw or a potential problem of the BCG matrix. Thirdly, we talk about something called as unkind animals. Animals here basically refers to what? If I talk about BCG matrix, one is cash cow and the second one is dog. So let's understand this. Cash cows and dogs usually receive ungenerous treatment. Ungenerous treatment. Why is that so? The former simply milked. Former here refers to cash cows. Cows are basically simply milked. That means basically these are used only for what? For taking the money out of them, because they are what? They are cash generating machines. Fine. And the latter terminated. Latter terminated means latter here refers to dogs, and the dogs are believed to be terminated. What this can do is, this can basically demotivate managers, as managers in these units see little point in working hard for the sake of other businesses. So if I'm working in any of this category of cash cow and dogs, and cash cows generally are milked, that means only they are used for the purpose of generating cash, and dogs are basically closed. So what will eventually happen is that the managers basically who are working here will get demotivated, and they would see no point putting in hard work, because eventually they know their business is not going to sustain anymore, and they don't want to work for other businesses because their growth has come to a standstill. Fine. There is a danger of self-fulfilling prophecy. That's something we have already discussed. It's basically a psychological phenomena where you basically assume that your predictions will come true. So that is what is called a self-fulfilling prophecy. You think whatever you are thinking is basically right. Cash cows will become dogs even quickly than the model expects if they are simply milked and denied adequate investment. That is very obvious, and that's something we have already discussed. If you keep on milking the cash cows, then what will happen is that they will be only used as a cash generating machine, and no investments will be done on them. Now, notion that a dog can be simply sold off assumes that there are no ties to other business units in the portfolio whose performance might depend on keeping the dog alive. There may be situations where dog may be not generating adequate revenue for you, because we know that it doesn't have a huge market share or good growth rate, but it may be necessary for keep the business running. There may be many situations for that, but dog need not be closed all the time. This portfolio approach to dog works better for conglomerate strategies. So in smaller companies it doesn't work much because you have to keep your dog alive, but this portfolio approach to dog, that means shutting down the dog works for bigger organization, that is conglomerate strategies, where divestments or closures are unlikely to have knock-on effects on other parts of the portfolio. So if I have to say that dogs are closed, then eventually that won't take a hit on the portfolio, but there may be situations wherein it may be a small conglomerate, that means maybe a small company, but this dog may basically be generating some good revenue for them. So if you just close it down, that basically can take a hit on your revenue. So it's important for you to keep dogs basically working in many situations, unless and until it's a big conglomerate for whom dog doesn't make much of a significance. So that's what it talks about. So here are the three potential problems. One is definitional vagueness, one is capital market assumption, and third is unkind animals. With this, we finish the BCG matrix and the portfolio analysis. In the next chapter, we'll be looking at what? We'll be looking at the stages in strategic planning. Thank you for joining me, and if you like this video please do press the like button. Please share with your friends, and if you haven't, make sure that you subscribe to our channel. Thank you so much and enjoy your learning.